Ladies and gentlemen, distinguished guests, and my dear colleagues, a very warm welcome to the launch event of a special report on the Indian microfinance sector. This is a new product launch from Acuité Research, a division of Acuité that will engage in cutting-edge industry research, forecasts, and opinions. I am Anthony Jose, Chief Rating Officer at Acuité Ratings and Research Limited, and your host for this evening. Indian microfinance sector is estimated to be the largest in the world and has really come a long way from its inception in the 90s, despite several challenges. We are honored to have you all with us today as we unveil our research on this important industry. To begin with, let me introduce our esteemed guests who have graced us with their presence today. Please join me in welcoming Mr. Tamal Bandyopadhyay, Consulting Editor, Business Standard. Mr. Bandyopadhyay is one of the most respected senior business journalists in India. His weekly column, Bankers Trust, is widely read for its deep insights into the world of finance and its unerring ability to anticipate major policy moves. A postgraduate in English literature, Tamal has worked with 4 national business dailies in India: Business Standard, Financial Express, Mint, and the Economic Times. He has authored 7 books on banking and finance, all of which have been non-fiction bestsellers. He is a recipient of the Ramnath Goenka Award for Excellence in Journalism in 2017. Our next guest, Dr. Alok Misra, is the CEO and Director at Microfinance Institutions Network, MFIN. Dr. Misra has over 28 years of professional experience in policy design, analysis, implementation, and evaluation of inclusive finance frameworks across 22 countries. With a keen interest in developing young talent, he is also a professor in public policy and governance and a consultant for inclusive finance. He holds a fellowship from Tufts University and completed his PhD from Victoria University of Wellington and holds BA Honours from Delhi University. Additionally, he holds a management diploma from the Asian Institute of Management and a certification from Harvard Business School. Welcome, Dr. Misra. Mr. Manoj Kumar Nambiar is the Managing Director of Arohan Financial Services Limited and also the Vice Chairman of the MFIN Governing Board. Mr. Nambiar has over 3 decades of rich and diversified leadership experience. He holds a specialization in microfinance from Harvard Business School, 2 management masters, and a bachelor's in engineering. Thank you so much, sirs, for being with us this evening and gracing this event. I'd like to introduce all of you to the agenda this evening. First, we will have a brief presentation from our Chief Economist and Head of Research, Mr. Suman Chaudhary, to share a few insights from our MFI report. Then, we will launch our research report titled Microfinance in India, Macro Positive. Thereafter, we would request our guests to share their perspectives and opinions about the sector, starting with Mr. Tamal Bandyopadhyay. Finally, we'll wrap up with closing comments. Microfinance in India, Macro Positive, is a comprehensive report and is your passport to the dynamic world of MFIs, covering the entire spectrum from industry bigwigs to the emerging players. Our on-ground surveys reveal the strategies propelling success in today's challenging landscape and the transformative impact of digital technologies. Additionally, it puts the spotlight on the evolving regulatory framework and the funding dynamics shaping the industry's future. To provide us a flavor of the report's findings, please join me in welcoming Mr. Suman Chaudhary, Executive Director, Chief Economist and Head of Research at Acuité Ratings and Research Limited. With over 27 years of experience in credit ratings, credit research, and credit risk, Suman has seen the evolution of the microfinance sector from close quarters. Over to you, Suman.
Am I audible? Thank you. Thank you, Tony. And welcome to everyone. This is a very important occasion for us on the launch of the special research report on the microfinance sector. And I would particularly like to thank our guests who have taken time out, Mr. Bandyopadhyay, Dr. Misra, and Mr. Nambiar from their busy schedule. They have given us time and they will be sharing their valuable opinions on the sector. So I think my job here is to just give you a flavor of some of the conclusions that we have arrived at from this research report, and also share some of our perspectives on the sector. So before I start, while I was preparing the presentation, I was thinking what kind of title we should give. Then I was reminded of this mythical bird that in Greek mythology, the phoenix. And they say the phoenix rises from the ashes. So it's about this mythical bird which kind of builds its own funeral pyre, and then gets consumed in the fire, and then again rises from it, again emerges from it. It's like kind of a rebirth. Now, after the COVID, but the severe disruption of COVID, the way the microfinance sector has emerged, it is nothing less spectacular than the rise of the phoenix from the ashes. In fact, it is not just COVID. If you really look at the history of microfinance, starting from the Andhra Pradesh AP crisis in 2010, followed by the demonetization in 2016, and then, of course, COVID, which happened in 2020. In between, you had multiple weather catastrophes, cyclones that keep on hitting the coastal regions with regular frequency. All of this have kind of had a shock impact on the sector. But if you really look at it today, the sector is still live and kicking. It has demonstrated its resilient nature. And what we can say today, that it is not anymore a fringe. It's not a fringe of the financial sector, but it is now really a mainstream. It has come to the mainstream.
Let us now have the privilege of hearing our esteemed guests who have decades of ground level experience in the microfinance sector. I'll first request Mr. Bandyopadhyay to share his insights and outlook on the sector. Over to you, Mr. Bandyopadhyay.
Well, thank you. Actually, if I use a cricket analogy, of the three of us, first is Arohan boss, he is the player, he is in the field. MFIN big boss is a sort of umpire or a part of the selection committee, and I am the commentator who has never played cricket. So don't take what I am saying too seriously. That's all. Everybody says that when when this I would like to believe that till about December, the outlook on microfinance was pretty bad. I have been in conversation with investors, a very bleak outlook. So to that extent, this phoenix comparison I like. Yes, it has come out of the ashes, and there is a lot of positivity about it. And typically, if you ask anyone what's the reason, the answer is, these guys are always cash flow based. So whenever the business has come back, and the money will start coming back, and there is no, they're not one of those corporate entities who want to cheat banking segment. Individuals are pretty good, psychologically they are pretty better. They are not cheats, they are not frauds. So that's the standard answer. Why this how things have changed. But with my little bit of whatever I have seen, I will quickly cut through this. There are three phases in Indian microfinance. One is from the 90s to till 2009, when we saw Vijay Mahajan, and those are the kind of persons. They started building the thing, architecture. None. And then Andhra crisis happened in 2010, Malagam Committee report, and RBI for the first time. Earlier, it was a sort of unregulated, but 2010 onwards, it's becoming regulated. It became regulated. And then what we have come here now, this 2022 beginning, when the Reserve Bank of India came out with the new guidelines. Now, while between 90s and up to 2010, there were some East Godavari crisis and larger Andhra Pradesh crisis where the state government stepped in and created problem. But between 2010 and now, there are multiple things happening. I mean, one thing happened is that Assam became a sort of rotten apple, which is a creation of microfinance industry on its own, microfinance. And then, of course, we have seen GST, we have seen demonetization, and finally, we have seen this entire lockdown for during to COVID. Now, my understanding is this. Even though to a large extent RBI can take the credit, but I think GST, demonetization and lockdown, all three actually contributed to the hygiene factor of it. So those who are not to be, not to be there, should not be there, those kind of entities, those kind of people have been out now. Now if you see the profile of the borrowers has changed and is far better, and these are and then of course your analysis also going better because of the GST and etc. So that way things are far better now. Now RBI's contribution is great. What the presentation did not mention is this. I think the biggest contribution what RBI did is this: the focus has now shifted from microfinance entities to microfinance. So the arbitrage opportunity which was mismanaged by certain banks, which created the Assam problem, it will not happen anymore. Now RBI is concerned about not MFIs, but the entities which are in the MFI business. It could be banks, it could be NBFC MFI, it could be not-for-profit MFI or trust, it could be SFBs. Whatever entities you are, RBI's now lens and the radar on the radar is the microfinance itself. I think that's the biggest change that has created a level playing field. Otherwise, it was pretty claustrophobic for certain microfinance entities in certain geographies, and certain banks were taking unfair advantage. That's point number one. Point number two, what is changed is this: the cap, the 10% cap on reasonably sizable microfinance entities on their cost of borrowing has now gone. So which means you can have your own cost analysis. You can have also differential cost for different within the same geography for different people. So what is the benefit of that? Two things is going to happen, I guess. Is this the group concept may ultimately, you may not have the group concept because you cannot have differential interest rate within the same group. That will create problem. So I think more individual entities come in, more men also come in. It will not be dominated by women predominantly, what is the case now, and that's in future. I think more individual will come instead of group. But for the timing, what has happened, if I'm not mistaken, each and every microfinance has raised their interest rate and the margin has gone up. It's another matter, the banks too, most of the banks do charge even higher than the microfinance. I know a few banks, including foreign banks, charging 24, 26, 27%, which is equal or more than some of the microfinance entities. So there is no qualm about it. Advantage is this: the microfinance borrowers, they don't go by 15% or 17% or 20%. They go by what is my monthly installment. That's it. So that's it. And the third thing which has contributed to this is, I think, the credit bureau part. What was happening earlier is this, that microfinance entity was only checking what is their exposure to microfinance. Now, if I am the borrower, if I have taken an auto loan from banks, if I have taken education loan from banks, if I have taken housing loan for banks, etc., etc., it was not on the lens of the microfinance entities. Now, the coordinated efforts, all the credit, whatever my exposure is, on the table. So that has far improved the credit assessment by the MFI entities. So what happened in the past 1 year or 1.5 years is this: they have cleaned their balance sheets, they have made huge provisioning to take care of their thing, they have written off their loans, etc. And now the people are like in the business and they are able to give return the money, etc. And meanwhile, what happened? Two things. One is this: their ability to assess the credit worthiness of the borrowers have gone up, and technology is playing a critical role. I would like to believe all 90% plus microfinance entities, entire collection is now, entire disbursal is now through the cashless. Yeah, it's cashless. You need to have a bank account, and through the bank account the money goes. Probably 95% or I don't have that. I understand that some of them or many of them also started collecting, making the collection cashless. They're starting 10%, 15%, 20% that way. We need to wait for a couple of years or maybe 2-3 years to make that happen. So that will without, if the microfinance entities do not lose the human touch, it is essential to have this. But at the same time, if they can increase their exposure to this entire cashless thing, I think their cost will come down and they will do far better. So that's the current situation. A few things I would like to point out in future. I don't like to take too much of time because everything was explained here. And as I said, I'm a commentator, not a player, not an umpire, which two of them, I think they will do far better analysis than me. One thing I would like to say is this 20%, 25% you can give to other entities, which Reserve Bank of India has said, which from 85% to come down to 75%. It's of not much of use because the cash in hand also, I think it's a part of this. So what does this mean? That when I am a microfinance entity, I am giving for the fixed deposit, etc. certain money I need to keep with the with certain fixed deposit I need to keep with the banks. I don't want to use the technicalities to get the loans, etc. If I'm raising debt or equity, etc. at this point of time, whatever on my books, that will all be part of this 25%. So I think if there is any RBI in the audience or the rating agency or the industry should take it up with Reserve Bank of India to bring it down further. 75, with the difference between 85% and 75% virtually does not exist anymore.
Make it more effective.
Second part is this: I think Reserve Bank of India, what it can do, again, industry can take it up, like they have introduced the scale-based regulation in terms of general NBFCs and getting people in the upper limit and middle limit, etc., and treating them virtually on the bank line, including the LC or the liquidity coverage. I think in the microfinance kind of thing, they can introduce some kind of scaling, and the large microfinance entity after the central should be allowed to give more loan than 3 lakh. Then 3 lakh, which is the total amount one can, eligibility part. Like 3 lakh, you can give 1.5 lakh, etc. I think to help the MSME and SME segment, particularly MSME segment, which is the national theme now, help the MSME. If RBI get into the scale-based thing for the MFI and NBFCs and pick up some 10, 20, 15, whatever the large MFI and NBFCs, and allow them to get into the beyond this 75%, 25%, also more get into the MSME segment. Actually, that would be a far better, interesting thing. And final word is this. Final word meaning not in terms of importance. The observation is this: certainly everybody in the lending segment, they are finding the worth of microfinance. Now, if you look at the banks in the metros, etc., they are seeing a saturation point, and they are seeing the margin there is beyond certain things they cannot have any margin. It could be 3%, 4%, etc. And they have always the advantage of lower cost of fund because they can access deposits. So now they are pretty aggressive, because where else you get this kind of margin? 7, 8, 9, 10% margin you can have, if not more. So I know at least 2 banks which are consciously not only going for microfinance growth within their portfolio, they are looking for acquisitions. They want to acquire. In fact, one reasonably large bank, scheduled commercial bank, one SFB, they are hunting for microfinance. So I think the competition will be very tough for microfinance. Not unfair advantage, not what the banks were doing it, but even on a level playing field, you always have the cost disadvantage, and banks have the cost advantage. And the banks are very aggressive because going beyond metros, etc. If they are technologically they are well equipped, they can enter. Many of them are doing through BCs, but going beyond the BC route, they want to also go directly there. And there, I think one needs to be little careful. I think instead of making it a saturation at certain areas, I'm sure there are certain areas which are still not that kind of invaded. So probably one of the way of doing this for microfinance entities will be looking for new pastures, doing things in a different way, and like there are multiple things I can continue. But the point I'm making is not a concern. We are seeing that banks are becoming very aggressive, not the way which created the Assam problem, but the larger banks, the bigger banks, the mid-sized banks, they want to use this opportunity to have a larger NIM, net asset, interest margin, which in the normal housing loan and car loan and normal personal loan, it's not possible. So here I end, and later if there's an opportunity comes, I'm happy to discuss. Thank you. Thank you.
Thank you, Tamalda, for those really interesting insights. Now I will request Dr. Misra, CEO of MFIN, to share his perspectives. Over to you, Dr. Misra.
Well, thank you. And I am grateful that you have invited me here. Thanks to Acuité. Well, Tamalda and Sumanda had already, I think, almost covered most of the aspects. Normally, as Tamalda alluded to me as an umpire, and umpires should normally speak in the last, but I am in between. So I think if umpire makes any mistake, players, the Manoj will correct it. But I would like to talk about a few things which I think have broadly not been tried to do something which is not repetitive, which has already been told by my earlier speakers. I will start by saying that when we talk about microfinance, its growth, whether you call it Phoenix or I always view microfinance as when it grows, it is not a proposition only for the enterprises or the entities which are in it. Yes, they are in it for it. Of course, they are not doing it for a charity. They have their own business interest and all that. But the country needs them more. We should always keep remembering that. When we are today talking about India becoming a 5 trillion economy, and I think the role of microfinance in doing that is very important. And I want to dwell a little bit on it. Because even if we become 5 trillion economy current, at the way the society and economic incomes are structured currently, it will be a very unequal economy. And that will not be sustainable in my view in the long run. So the growth has not, we have not only to cross 5 trillion, 6 trillion, 7 trillion, whatever it is, that number, but that distribution of income, the Gini coefficient as the economists call it, has also to improve for the country. And if that has to happen, I think microfinance is the answer. That is what leads to inclusive growth. And if you don't have inclusive growth, I think the growth numbers will only lead to inequalities and will not lead to stability of the economic growth. So for a robust, solid, sustainable economic growth, the importance of microfinance is there. So not that because I am the CEO of MFIN, I am saying that. I've always believed that if microfinance grows, but within those parameters, I will talk about those parameters also, then it will lead to an inclusive growth of India. And that is very important, that we should continue to celebrate the growth of microfinance. Other than economic growth, the contribution, we all as economists keep talking about the jobless growth, because much of the growth in India has come from services sector. Earlier it used to be most of them before independence be employed in agriculture. Now most of them it has growth and numbers of employment has come in services, and it is not that job creating environment. So microfinance is one which creates jobs at local level. In our study with NCR, it found that if we give one loan, it creates at least 2.3 jobs, So 2.3 is a fraction of number by study. It is not practically possible. So even if we say 2 or 3 in some cases, that's important. It lets the people stay in their locations, basically rural or semi-rural areas. It checks the problem of migration. So there are so many other issues associated with it. When you deal with women clients and do it with the true spirit of microfinance, you are also educating a family. You are also educating about health. You are also educating about sanitation and so many other issues. The problem of gender equality is also being addressed by microfinance. At our MFIN, we made a list of indicators of SDG where microfinance makes an impact, and we could see many indicators it makes an indicator. So I will not get more into it because the topic is somewhere else. But what I want to say is that if there is a controlled, sustainable, responsible growth of microfinance, it is a cause for celebration and it will lead to stronger growth model for India. Now, on the second part of it, I would like to enumerate a few things because we talk about diverse legal entities playing in this space. Banks, small finance banks, NBFCs, NBFC MFIs. And as the presentation showed, my data shows that as of June, the NBFC MFI share in the microfinance model is 41%. Now, the NBFC MFI models, which are primarily our, what earlier we used to call to be member, now we have changed. Now all the regulated entities with microfinance portfolio are our members. So the NBFC MFI is, because not only microfinance is their bread and butter, but there are other disciplines with the industry through MFIN has adopted over the years, which is not known very frequently. So I would like to enumerate a few things. One is that we have mandated, while the regulation says that the credit bureau data should be submitted on a monthly basis at least, but we have mandated that the files should be submitted on a daily basis, and all our big members are submitting files on a daily basis. And very few people know about it, and that's a humongous achievement. And today, when we take it to the technical working group of RBI and say that banks should also report it, because it leads to, if you continue to report at monthly level, it leads to introducing vulnerability in credit assessment of a poor client, which will end. But there are problems in that. So we report data monthly. The household income assessment and various rules, which were narrated by Sumandai in his presentation by RBI, they are just very broad principles now. We have come through the NBFC, MFIs have come through a regime where everything was under regulation, where 30,000 loan has to be 1 year, more than 30,000 has to be this much for income generation, this much for that. So compliance with rules comes naturally to this set of players, and so many stricter rules they have gone through. The third thing which is very important is that the data with the industry through MFIN publishes at quarterly basis, and then there are periodical publications, is the best in class. You hardly get such level of granular data of any other financial sector class. And the other thing which is also very critical to our sector is that the amount of scrutiny we receive, whether it is from media, whether it is from government, whether it is from Reserve Bank of India. And you can understand that in a segment which today caters to 7 crore low-income women clients all over 727 districts of India, even if 4 customer complaints at our toll-free number are pending, RBI takes a phone call or writes a mail to us that why those 4 pending complaints are there, what happened in that case and that case. So that level of scrutiny is there. One incident happens somewhere, and that immediately, like something happened in Calcutta 2-3 days back, it has immediately come to us. So we are constantly under scrutiny. And it is good to be under scrutiny. I always say that it is not bad to be scrutiny. Sometimes we feel the pinch, but it is good also because it makes us responsible. So the sector follows a lot of discipline. And as an SRO, we always say that while we are an industry association also, we will not only be on the advocacy front, or as I say, the cheerleaders of the association or the industry, but we will also make everything possible to enforce the rules and regulations which are there. And if there is and we have seen cases where members who could not comply, or if we said something, they had moved out of MFIN. So we are okay with that. For us, credibility, enforcement of rules is very important. And we are fortunate because it is the only body which is supported by the fees of members, and still we discipline them and they bear it with a smile on the chin. So these are the things which make the industry a very healthy industry. Now, on the another part of my speaking, I wanted to talk about a few things in the presentation which were talked about. Diversification issue, Tamal had already addressed that it is not much of a diversification. It is rather, it has restricted the scope. We are lobbying with Reserve Bank of India. We are pursuing it at the highest level with the governor also. Even on 18 September during pre-MPC meeting, I raised this issue with that. So we hope there will be some resolution, because the main problem is it is a static concept. Now you have to comply as it on total assets. So moment you receive debt or equity, 500 crores or 600 crores for a 5,000 crore company, you cannot immediately deploy it, and it will lead to breach of the cap. So I think logic is clear, and Reserve Bank will work on it. On the securitization piece, I think there was one thing which was said, which I would like to clarify for, I think, for the report. When we calculate the share of various regulated entities like NBFC, MFIs, banks, SFBs, this 40%, 41% share of NBFC, MFI does not include securitized portfolio, because securitized or DA portfolio moves to the balance sheet of the other lender who has purchased the portfolio. So this is own book portfolio share, which is 41%. Otherwise, it will become a double counting. Banks will also report, we will also do. So 3,54,000 crore is the outstanding as of June of the sector, out of which 41% is there. So that one point I wanted to clear. And also on the risk side, I think I would read it in detail, the risk matrix of various states which Acuité in its report has put in. But one word of caution I would like to say that whenever I see the risk matrix being drawn for various states' portfolio, those Subandar said that various factors have been considered. But one factor which I often see is not taken into account, and which is very critical for mapping the risk factor of the microfinance sector, is that while we can say, for example, I say that Bihar, you say that the portfolio is 50,000 crore, and people immediately say that 50,000 crore, Bihar, too large, very high, risky, and all that. But we should correlate it with two things. One is we should try to see the formal sector. When I say formal sector, the traditional formal sector, you can say scheduled commercial banks, normal banking, and all that, and NBFCs. What is their presence in that state? And once you see the presence, also see the Reserve Bank of India publishes data on various loan amount wise category of loans in a particular state and sometimes in a region. If you analyze that, you will see that wherever microfinance has grown in last 3-4 years, whether it was in the eastern sector, though we had some problems in Assam and West Bengal also, I would not deny that, because of various other factors, and Bihar, Odisha, and all those parts of the country where financial inclusion was low and microfinance has made it rich, the demand was already there. If we would have done very high in Maharashtra or Gujarat, which is or a typical South, that would be a counterproductive, because the formal institutions' reach is also there. So I feel that factor also needs to be factored. Whenever we do the risk analysis, we take that factor also. Now, coming to the final part of it, while everything is gung-ho and everybody says macro positive and sector is why equity investors are in, debt investors are in, I would like to end with three things. On the positive side, why this positivity is there, and three things for the future, which I say that must be adhered to. Otherwise, there will be something or other will rock the boat. We have to be very careful. So first thing, which are on the positive side, regulation. Yes. Tamal also alluded to it earlier in the presentation also, it was alluded to it. Regulation has become very positive, because the most positive thing which it has done is that after 6, 7, 8 years of regulatory arbitrage, it has leveled the field. But other than that also, a most important factor has been that the indebtedness level has been capped. That you cannot give loans which are more than 50% of income in repayment capacity. So even if I earn 1 lakh rupees, if suppose my household income is 1 lakh rupees, my interest burden for a year should not be more than 50,000 rupees, assuming that 50% will be for meeting the basic necessities of life. I think that is a very prudent step. Interest rate pricing and all that, 70% of sector was already deregulated. It has only, what I would say, a wrong has already been corrected. It is not, I would not say it is a very major thing. Second thing also, I think, which has been talked about is the credit quality. Now, in credit quality, if we see that pre-pandemic levels has already been reached, because if I see PAR 60 days means PAR, if payment is delayed from 1 day to 60 days figure, in a portfolio which has matured for 13 months, that is more than 1 year, 1 month. A typical microfinance loan is 18 months on an average, 12 to 18 months. So, which is almost 2/3 of its currency. There also the credit quality remains at 0.7%. The portfolio at risk is only 0.7%. So I think it is almost returning, almost returned to pre-pandemic levels, and that is giving confidence to investors, equity, and lenders. Third point was the funding. The funding, we are seeing renewed interest on both equity and debt, and I think your report also talks about it. Now, going to the future, we see that the sector, we had last year projected that the current market size potential of the sector is 17 lakh to 16.5 lakh crores, some figure around that figure. And we have reached only 3.5 lakh crores. And there is a huge, humongous work ahead of us. We should not rest on our laurels that we have got 3.5 lakh. A lot of things need to be done. And now in this positive environment, there will be a tendency for funding is coming in, regulation is positive, for lenders to go overboard, to be indiscriminate in the lending. So I always say, yes, there is a long runway. We can grow sustainably at 20-25%, some year maybe a little higher. But three things will be key. And as an SRO, we will keep emphasizing it, and we continue to emphasize that. One is a very strong adherence to norms. For example, I would give you, while credit bureau is there, rules and regulations are there, but sometimes I have seen in my life that it boils down to intent of the organization. It boils down to the intent of the governance. I will give you an example. Suppose 50% household income is capped as an indebtedness. You take the comprehensive credit report of a borrower, but your policy excludes certain loans, that this is a balloon loan I will not take into account. This is this loan I will not take into account. Then you defeat the very purpose of regulation, and you will lead to indebtedness. So that is one aspect of strict adherence to regulation. Similarly, on pricing, while it is good that now the pricing is deregulated for entire sector or whatever player you would be, we have to act very responsibly. We are not a hedge fund industry. We are not a mainstream industry where you can charge any rate and get away with it. Yes, everybody understands you have to be profitable. You have to give return to investors, but it should not be runaway profiteering. And the policy, whatever you charge, has to be properly documented through a board-approved policy, through an SRO scrutiny, and we will be looking it into very closely. That will be another aspect which we have to look into it. Third thing is the field discipline. The field discipline also currently, and earlier also it has started happening, but in COVID times, because of the lockdown and other things and digital methods, there have been issues of, what should I say, client relationship, field meetings and all that, group center attendance and all that getting a little bit diluted, and a little bit problem of combined with the problem of higher staff attrition. I think these two things also have to be addressed very carefully. Otherwise, the growth momentum juggernaut will come to a halt and there will be root shocks. We have to control that. And last point, which I want to say, sorry, I think I have exceeded my time limit because there is so much to say, is that we are working with RBI. We are trying to emphasize on that. That another big elephant which sits in the room, which is not part of the credit underwriting system, is the SHG bank linkage program or the NRLM program. It is almost a complete overhaul, complete overlap with this system, but we need to bring it to somewhere or the other. It has to be brought into the system for proper underwriting. And along with that, the other segment which is also growing in proportion, which is now roughly around 30,000 crore, is the so-called digital lenders or fintech players, which are lending to the same set of clients. Loan sizes are even smaller than MFIs. Interest rates are 40%, 50%, 60%. No following of microfinance norms. They have also to be brought within discipline, because if some field issue will happen, it is the well-regulated microfinance institutions whose name will get conflated with that. So all these 3-4 issues are there which we need to tackle. Somewhere there is policy action required. Somewhere our institutions, MFIN as an SRO, our players have to be cautious about it. If we do not pay heed to it, I think the growth momentum will have some problem. If we pay heed to them, I think there is a long runway to it. Thank you very much. Sorry for passing my time.
Thank you, Dr. Misra, for sharing your thoughts. Now I request Mr. Manoj Nambiar, Managing Director, Arohan Financial Services Limited, and also the Vice Chairman of the MFIN Governing Board, to share his outlook on this sector. Over to you, Mr. Nambiar.
So first of all, good evening to all of you. Thank you for the opportunity to be able to share our views, especially as Tamalda and Alokji said, as a practitioner. And since most of the points are actually already covered, I will really focus on the huge opportunity that this particular business actually presents in front of all of us. As we discussed, for a country with 1.4 billion population, 20, 30, 40% being the target segment in terms of the definition that RBI has put in. And today with 3.5 lakh crores and roughly about 70 million customers being sort of served, one is the employment opportunity. Even if you take 2 jobs being created, you're talking about at least 140 million people essentially being able to benefit from the sector. And in a country where employment growth is very, very important, this is even more important for the fact that if the sector grows, you will essentially have a huge opportunity on the other side. If the country has to grow at about 9-10% and cross that single digit sort of Hindu rate of growth, as we've always said, 6-7%, that can only happen when the BOP grows. And for the BOP, whatever credit facility goes, and if it is properly utilized, you will see multifarious benefits essentially coming from that. Apart from the fact that lending to that particular segment has actually historically been proven as as extremely safe and sort of viable. Pre-COVID, I would say this is a sector which has delivered more than 99% collection efficiency, less than 1% credit cost. Being an unsecured business, this is an asset class which can actually give secured assets a run for their money. Given the fact that it is very granular, and if properly done, you would be able to manage collection efficiencies of 99% and manage your credit cost in terms of the 1%. Thousands of branches, lakhs of employees being sort of employed in the sector, millions of customers being served across the hundreds of districts that we spoke about. All of these are other points which are extremely important. At 3.5 lakh crores, the industry association MFIN, we still believe that it is hardly 31-32% penetrated. So one can imagine the kind of potential which is there, and that is the reason why you see today that with the passage of the pandemic and the pains having been taken care of, whether it is through provisions, write-offs, or whatever be the method that people have used, including ARCs who have actually come forward to help us. I would say the next 3 to 5 years presents a real growth period for the sector. Of course, given the conditions that one needs to be careful about what is happening on the field, one need to manage the risk concentration better and have practices which will essentially help the sector grow smoothly. 2-3 key points. I think the whole legal gray area between state and RBI has been extremely now cleared. Between the High Court judgment and the Supreme Court judgment, there is no iota of doubt that something like an AP or an Assam cannot happen again. Number one, which is a huge relief for investors, lenders, and basically practitioners in the sector. The RBI guidelines have already been spoken about, whether it is definition of the segment, whether it is the fact that we have harmonized credit across types of lenders in the sector, and also the fact that the pricing freedom, which was only denied to one particular category, which is NBFC MFIs, essentially have been freed up. So now we can price for cost and risk depending on the segment that you're actually catering to. If in a particular state, a particular segment is performing well, you need to be able to give them a slightly lower rate so that they see the benefit of actually paying back on time, as compared to a new to credit customer or a geography where the delinquency is slightly higher. Instead of denying them credit, today you can price that for risk and essentially ensure that they're able to access credit. I think it's also important at this point of time to understand that the other option of people who do not get access to formal credit is the unorganized sector, which in most cases is 10 times higher in terms of pricing than what we offer. So one has to keep that in mind in terms of the fact that while 24%, which is the median pricing today, might look high, the OPEX that we need to go through, given the fact that it's a doorstep service and the kind of unsecured nature, given the external disturbances, climate changes that we are going through today, local disturbances, customers not paying and all that put together, has to be factored in. Now, if you look at the sort of financial metrics that you actually showed in the report, it is not that people are making some 5% ROA or maybe 25% ROE. You will only be able to attract investors when you show a decent ROA and at least a close to 20% ROE. On a continuous basis, if you do not show that, you will not get the investment. And if you do not get the investment, you will not be able to grow. So in this business, it is about 100 rupees of equity and that being leveraged by about 570 rupees of debt, given the fact that we have a 15% capital adequacy. So if that 100 doesn't get increased, you will not essentially be able to grow. The other point that I wanted to highlight was the fact that one has to understand that the foundation has been strongly laid. The credit bureau discipline, we have 4 credit bureaus today which have more than 250, 300 million credit records of people who've ever taken a loan from 2009 onwards. Right? So it is very, very rich in data, and all the underwriting that you can do, you have access to that data which will help you underwrite better. The Jam Trinity, Jandan, Aadhaar, mobile is now helping us become cashless, is helping us being able to leverage the IT enablement and essentially ensure greater amount of control apart from bringing down the OPEX. So at the end of the day, 2 weeks of TAT, which was there earlier for a customer to get a loan, today in the case of companies which are IT enabled, you can actually give credit in just about 10 minutes flat, because you have access to that credit bureau data. The legal issue being sorted out, and that is the reason why you see a lot of investment, a lot of interest in terms of the fact that even lending to an MFI essentially is PSL benefit for the bank. So when Tamal mentioned that there are at least 1 or 2 banks looking out for acquisitions, it's primarily because the model that MFIs have created, being a low-cost model, very grounded model, very high level of sort of client connect, all of these are something that the banks can essentially use to be able to reach that particular segment, right? I will sort of stop by saying that in which other sector can you look at 25-30% growth on a year-on-year basis, get more than 99% collection efficiency, less than 1% credit costs, be able to deliver 4.5, 5% ROA if you are completely optimized with an ROE of around 20% and do social good in the process. I don't think there is any other industry in the country which can boast of these 4 USPs that you can offer if properly done. The SRO, the RBI regulations, the Government of India focus, the DFS support, all of that is only going to ensure that policies will be positive, and entrepreneurs like us essentially have that field where we are able to sort of look at the potential and grow. I mean, I would really say that the version 3 that we spoke about earlier is about to actually unfold, and a sector which was less than 9,000 crores in 2011 after the AP crisis. Today we are talking about 3.7 lakh crores, 4 lakh crores, reaching about 10 lakh crores in the next 3 years. So that really is the potential that I would look at as a practitioner. Tamal has already covered the broad sort of views from an external spectator perspective. Alok has already covered from an SRO perspective as to what we should look out for. So I would really say that as an entrepreneur, I'm looking at the opportunity which is there in front of us, given the fact that a whole lot of pain has essentially been addressed. Thank you.
Thank you, Mr. Nambiar, for those rich insights into the sector. I'm sure the audience would have many takeaways from this session. Finally, as we draw this remarkable evening to a close, I would like to extend our heartfelt gratitude to all our guests, panelists, and of course our audience for joining us today. Your presence has made this event truly special. For any inquiries on our research services, please write to us on our email ID info@acuité.in. That's info@acuité.in. Have a wonderful evening, and thank you once again for being a part of the Acuité Ratings and Research Limited Industry Report launch. Have a good evening.
Thank you.
Thank you. Thank you.
Thank you.